Hi, I'm Ali Kodadad, Head of Income Planning for CBS Brokerage. Many people believe bipartisan cooperation in DC is a thing of the past. However, one area where both parties continue to agree is spending. We see that most clearly when we look at the size of our federal debt and, more importantly, our debt to GDP ratio. As of early 2026, U.S. federal debt is approaching $39.1 trillion. That is trillion with a T. Numbers that large are hard for anyone to fully grasp. I struggle with it myself. Because the dollar amount continues to grow due to spending and inflation, I find it more meaningful to focus on debt relative to the size of the economy rather than the dollar figure alone. Today, our debt to GDP ratio is roughly 125%. The last time the United States experienced similar levels of debt was in the mid 1940s during and immediately following World War II. At that time, in order to rein in debt and stabilize finances, Congress raised the highest marginal federal tax rate as high as 94%. Today, the top marginal rate is 37%. It is true that very few people actually paid 94% of their income in taxes back then. However, effective tax rates tell a more complete story. Historical data suggests that the top 1% of wage earners paid roughly half of their income in federal taxes during that period, while today the top 1% pays closer to one quarter. In addition to already high debt levels, both political parties have continued to run large annual deficits. For fiscal year 2026, current projections show nearly $1.9 trillion being added to the national debt. At this point, there is no clear plan in place to meaningfully reduce those deficits, which suggests that the total debt will likely continue to grow. We also need to factor in Social Security. The Social Security Trust Fund is expected to face depletion sometime in early 2030s. Social Security is an extremely popular program, and it would be politically difficult for lawmakers to ignore this issue. Addressing it will likely require some combination of higher taxes, higher borrowing, or benefit changes, all of which may further impact our debt and debt to GDP ratios. Now, by nature, I'm an optimist. I believe firmly in American ingenuity, innovation, and resilience. The U.S. stock market has delivered an incredible run since the financial crisis of 2008. However, many analysts believe future equity returns over the next decade may be more muted than what investors have experienced over the last 15 years, and elevated debt levels could be part of that story. While presidents often express views about interest rates, it's important to understand how rates are actually set. The Federal Reserve primarily influences short-term rates. Long-term rates, such as the 10-year and 30-year treasuries, are driven largely by the markets. Investors may demand higher interest rates when lending money to a government with rising debt levels and no clear path towards stabilization. All of this contributes to uncertainty in the markets. And as we all know, markets do not like uncertainty. In that environment, it is reasonable to expect periods of muted growth or even market corrections along the way. One potential tool governments historically use to manage large debt burdens is currency debasement, which essentially means reducing the purchasing power of the currency over time. For investors, this creates a challenging environment where it's important not only to outpace inflation, but also to manage downside risk. This is where certain income and risk management strategies play a role in a broader financial plan. Registered index-linked annuities and fixed index annuities can offer ways to participate in market growth while incorporating defined limits on downside risk. If you would like to explore how these strategies may fit into your client's planning during periods of uncertainty, please reach out to CBS Brokerage and your insurance specialist. We're happy to have a deeper conversation and help evaluate appropriate solutions based on individual circumstances. I thank you for your time and look forward to connecting.